Hello zone traders, this is Tomer and this is a new weekly market analysis video. In this video I will go over some of the charts that I've included in this week's newsletters, which are packed with interesting analysis and trading ideas, much more that I can cover in this short video. So if you want to read more, you can do it by visiting marketson.tumblr.com, my blog, and see all the analysis and trading ideas. And like I usually do, this week I've dedicated my intro words on stocks to the VIX and how you can use it to gain from spikes in volatility, as we saw last Friday following the Boston's Fed chief words that sent the S&P crashing down to a decline of 2.5%. And since the VIX is mostly relevant to stock traders, the intro words on the FX edition is dedicated to the dollar and what we should expect from it as it continues to range between two weekly price zones less than 2 weeks before FOMC. So two intro words, very interesting. Read them in the weekly market analysis this week. As I mentioned, I have very interesting stuff for you this week, including my intro words about the VIX and S&P, and if you are trading stocks, that's definitely something that you want to read, how you can benefit from the VIX touching the 12 handle and start thinking about becoming contrarian, shorting the bullish market when it reaches 12, and how you can execute these long volatility trades by not going long VXX. That's not my preferred option, and you can read why. We also have coverage for Apple with a successful bearish setup I had on it before iPhone 7 launch. Amazon, Twitter, two successful trades that we had in the lead zone last week. XLK, XLF, and more stuff. That's in the stock section. And in the Forex section, I mentioned the dollar with its weekly trading range. Euro USD, USD Yen, USD CAD, and oil. Very interesting scenarios on oil and USD CAD. So you can read everything in this week's newsletters, and you can find them on marketson.tumblr.com, my blog, or you can find them in your emails if you're subscribed to these free weekly newsletters. You can do it by visiting themarketzone.net and sign up for the weekly market analysis. Start your next trading week in the zone with these newsletters. Let's see what we have this week. The first chart I want to cover in this video is the SPY chart, the S&P, and if you recall, last week I mentioned in the newsletters that probably the only thing that we can take out of the sleepy summer market that we've been through is that the SPY closed below this uptrend line that you see right here. It bounced a little bit and rallied earlier last week, but when it reached the broken uptrend line, it found resistance, and as you can see, the impact was that SPY closed below the fast SMA line, below the 50 SMA line. This is the daily chart, and almost reached my final target zone for this current setup, the broken uptrend line, which was the previous record high near 212. 212 in SPY should act as support right now, and what was previously a record high and a resistance zone should act as support, but judging by the strength of the price action we saw on Friday, I say that we may see the market SPY touching 210, maybe even the 200-day moving average here. We have another Fed member talking on Monday, and we saw how Fed members affect the price right now, 2 weeks before FOMC, approximately 2 weeks before FOMC. If you shorted here the market, you should probably consider taking some profits, unless you are talking about maybe catching a longer term bearish move. You should definitely consider taking part of your profits near 212, 210, and definitely near the 200 days moving average. Looking for a pullback and maybe shorting the market again. If you are bullish, 212, 210, and maybe 208 are the potential entry zones if you are looking to get long again, long SPY before FOMC. So this is the SPY chart, and now let's see the VIX and what caused everything. The VIX was near 12, even just below it. And when the VIX is near 12, you can see that it creates huge spikes of volatility every time that it touches this critical support zone. And that is why I went long volatility, meaning shorting stocks like Amazon, Facebook, Twitter. All of them turned out to be highly profitable for us, and you can see everything on this week's weekly newsletters. This was a quick coverage of the VIX, the SPY. Now let's jump to the dollar index and see what happened there. Dollar index started last week by testing two moving averages that created a daily price zone, a resistance zone near 96, and when the price closed below the 50 days moving average, it was successfully pressed down to the bottom of its trading range, a trading range that has been active since 2015, between 94 and 98 in DXY. I'm describing in this week's newsletters, these MA lines, the 200, the 50, and the fast, which is the 18, can be used to find intra-week trading opportunities like we've seen last week. When the price reaches from below, you can short them. And when if the price will reach from above, you can perhaps use them as support lines to buy for a continuation move. But the most important thing is the trading range, and that is why when the dollar index reached 94, we looked for going long dollar index, meaning shorting Euro USD, shorting Kiwi, shorting Aussie USD, and shorting gold, for example. And we also had the support of two daily downtrend lines, which two broken downtrend lines that should have acted as support, and that's what they did. On Thursday, the dollar was pressed down following the ECB press conference, but it ended up as a bullish pin bar, confirming the support, and that was nicely followed by a bullish candle on Friday, following the Boston Fed words. So overall, the dollar index should continue higher. It will have to struggle with the 200 days and the 50 days moving average again. So maybe a bearish pullback here. But we are trading the range. That is why I'm expecting the dollar index to reach 97, maybe 98, to test the top of the trading range. And only if the dollar will break out of this trading range, we have two opportunities here. First of all, if it will break out higher, it will reach 100, psychological level of 100, to complete one of the best setups I've seen lately. Weekly triple top with the harmonics, with psychological level. Very interesting zone to focus on if the dollar index will reach here. Or if it will decline below 94, it has much room to fall, maybe towards 85, meeting 90 as support in the middle. But that's the situation in the dollar index. Trading the trading range right now with these options as a potential breakdown opportunities. The same picture we can see in Euro USD. Two successful trades on Euro USD last week. First trade was going long Euro USD from 1.11. This trading scenario was also posted last week on the newsletter, the weekly markets analysis newsletter. So if you read it, you could have made money from it. The target zone was 1.13, 1.14, and when the Euro USD reached 1.13, it completed a bearish bet pattern. So just before the ECB, I sent the lead zone members analysis saying that we're gonna look for a bearish opportunity on Euro USD, which turned out to be successful with a 100 pips decline on Euro USD following Draghi's words. This setup was actually, although it was sent to a lead zone members, it was also posted on my Instagram account as an example to what we do in the elite zone. So if you are following my Instagram account, the zones trader, you could have seen this setup also as well. As you can see, Euro USD, a mirror image of the dollar index, the 200 days moving average and the 50 days moving average, which was resistance in the dollar index, acted as support, and when the dollar index reached 94, that's where it spiked in Euro USD and became a bearish opportunity for us on Euro USD. So that is how you can use the dollar index to find good opportunities on major pairs. I want to close this weekly market analysis video by covering oil, which had a pretty wild trading week last week with a huge rally on Thursday following the inventories data, and even a stronger decline on Friday when the dollar rallied. And that's what we should expect from oil now that as we approach OPEC meeting in about a little bit more than 2 weeks from now. We should see increasing volatility in oil, and that's why it's going to be risky to trade the oil. In this week's weekly market analysis newsletters, I'm covering oil and USD CAD, which has been consolidating for more than 4 months now. So a very interesting scenario developing in USD CAD, and perhaps signaling that a huge move in oil and CAD pairs is about to come. If we are looking at oil's chart, this is WTI daily chart. We can see that oil is now below the fast moving average. As you can see, below the fast moving average, above the 50, above the 200 days, which is flattening, perhaps indicating that the bullish momentum is coming following its sharp decline, and below a weekly resistance zone between 50 and 55. That's a weekly zone, that's why it's so wide. And I have two harmonics here that I want to mention. The first one is a bearish butterfly that you can see right here. The completion point is just near $55, 54, 55. That's the bearish PRZ for this bearish butterfly pattern, and the other one is a potential bullish godly. Let me draw this one in red. So we have a bearish butterfly and we have a bullish godly pattern here. You can see them now more clearly. Okay, we have the B point of the godly just below 618. You can say it's a bet for those of you who want to be precise with the harmonics. So we didn't reach 618, so it can be a bet pattern. But anyway, we have two potential harmonics, godly or a bet, that completes between 41 and 40, just where the 200 days moving average will gonna be in the future. So that's a very interesting bullish opportunity on oil if it will decline all the way down here. And we have a bearish opportunity, bearish harmonics near 55. That's if the price of oil will reach all the way up here. So these are the two potential longer term scenarios I'm watching at right now. If you are swing trading or day trading, probably it won't help you much, but you can set one of these levels as potential target zone for your next trade. If you are bullish, you want to set the completion of the bearish butterfly. Also, of course, make sure that 50 is a level that you are taking profits at. But 55 will be a completion of a bearish butterfly, and if you are bearish, you can set the 200 days moving average and the completion of this harmonic as potential target zone. For me, 2 weeks before OPEC, I don't want to be caught in the mess right here in the middle. I want to wait for the move to reach one of these patterns, and maybe then look for my entries as potential longer term trades that I can benefit from stronger moves. But make your own choices. I just want to show you what I have on my charts, and that's it. That concludes our video this week. I hope you liked it. If you liked it, please share to show you care, and don't forget to subscribe to the channel so you won't miss anything, and subscribe to the newsletters so you'll be better prepared for your next trading week. Thank you for watching. See you on the next video. Bye.